So the government is to make new rules that could see cuts in pensions for retired people in defined benefit schemes. The legislation is to help pensioners who are left without an income where a private sector defined benefit scheme runs into trouble. So how will the new rules boost or hurt pensioners? On the line now, two people who have the answers: Aidan McLoughlin, Group Managing Director of the Independent Trustee Company, and Samantha McConnell, pensions expert with IFG Corporate Pension. First of all, Aidan McLoughlin, we're talking here about pensions in the private sector, which have benefits, defined benefits. In other words, they're based on final salary. I suppose the first thing to clarify is that by and large, people in these schemes, they will have the benefit of the state pension, contributory pension. That won't be affected first of all.
That's correct. There's no impact on state social welfare pensions. They continue to be paid as normal. So, this is purely focused on the private pension.
So there are three kinds of circumstance then where these new rules will apply. One where the company and the pension scheme are both insolvent. Then there's one where the company is solvent but the pension scheme is insolvent. And then there's a third situation where there's a restructuring of a pension scheme. So maybe you might just take us through those scenarios, if you would, please, Aidan. First of all, where both the company and the scheme are insolvent, what happens there?
Yeah, well, I suppose to observe first, there is a difference depending on whether you have what's known as a double insolvency or a single insolvency. So a double is where both the company and the scheme are insolvent. And in that case, the focus is on, firstly, making sure everybody gets to 50%. So in that case, pensioners can be restricted or reduced down from their current entitlement to 100%, down to getting 50%, until every other member of the scheme is also getting 50% of their benefit. At that stage, then, pensioners get priority to be moved back up to 100% for the remainder of their benefit. And then after that, if there's more money, other members of the scheme will receive extra on top of the 50% are guaranteed. The key gain that the state is, or the change that the state is doing there is to remove the priority, the 100% priority for pensioners, and to reduce it to 50%. And in fact, because of the Waterford Glass case, that actually has the effect of primarily saving the state money. So that seems to be the main justification for treating a double insolvency different to a single insolvency. The single insolvency case is slightly different. Then it's less of a restriction on pensioners. So in this case, the scheme is insolvent, but the employer isn't. The pensioner is prioritised based on the scale of pension that they're entitled to. If their pension is below 12,000, it's 100% guaranteed. If it's between 12 and 60,000, then 90% of the pension is guaranteed, and then if it's above 60, 80% is guaranteed. So the excess after that then is used to provide benefits of up to 50% to those that are still active in the scheme or still current members of the scheme. Once they've got the 50%, any excess beyond that then goes to top the pensioners back up to their full benefits. And finally, everybody else will be brought up to their full benefit. So it is quite a complicated formula in different circumstances, and it will be, for a lot of people, will be spending a lot of time working it out and scratching their heads.
And on the other one then, the third category?
The third category is that there isn't technically an insolvency, it's a restructuring of the scheme benefits, and it again allows you to reallocate, if you like, what people were entitled to bring up current members. So it is effectively a pre-insolvency situation. So you're restructuring benefits, as has been going on in a lot of cases anyway, but this allows or sets the formula by which pension benefits will be included in the restructuring, what effect it will have on those. So again, it follows the same formula of 100% of pensions up to 12,000 being included, 90% up to 60,000, and 80% for those greater.
One thing that appears to be common to all the situations then is that it still remains the case that people already on a pension will, in many instances, if not all cases, continue to do better than those who are still at work in terms of what they're assured of getting.
Yes. The only circumstance in which that doesn't apply is on the double insolvency, where they both drop to 50%, if that's all that's there. So the pensioner and the currently active member are treated exactly the same there if there isn't sufficient resources. The state guarantee of putting in additional funds will only bring them up to 50% each.
And so there's no particular advantage where the company and the pension scheme are both insolvent, the double insolvency.
That's correct.
So it's really in a case where there's either a restructuring or simply the scheme itself is insolvent. That's where the existing pensioners will continue to do better.
They continue to have a certain element of priority, but obviously it's been diluted from what it was before this announcement.
So how extensively used do you expect this scheme or variations of it to be? How is it likely to be implemented, or what kind of a call is there going to be on it, do you believe?
Well, the double insolvency isn't as widespread as you might think. Obviously, everybody's familiar with the Waterford Glass scenario and that arose and the litigation that relates to that. But the government had previously introduced a scheme in January 2010 called PIPS, the Pensions Insolvency Payment Scheme, which people in the Waterford Glass scenario could avail of, and the two schemes in Waterford did avail of. But my understanding is certainly up to the middle of last year there was only another 5 or 6 schemes that have availed of that. So you're not talking about hundreds of employers, you're literally talking about handfuls of employers that would be in the double insolvency scenario. The estimated liability from the industry for the Waterford Glass case was a couple of $100 million for the state. That liability has gone down as a result of this. The state will save itself significant funds because of this reprioritisation, because in effect pensioners will now give up benefit that they wouldn't previously have had to give up before the state has to put its hand in its pocket.
Right, now before I bring in Samantha McConnell, another pensions expert, let's just recall something that Michael Noonan said in his budget speech just a couple of weeks ago, something that didn't really attract much attention at the time, where he talked about changes to the so-called temporary pension levy, which was to end at the end of next year on the 31st of December 2014. Here's how he announced the change.
I wish to confirm that contributions to pension schemes will continue to attract income tax relief at the marginal rate of tax. I wish to confirm that the 0.6% pension levy introduced to fund the Jobs Initiative in 2011 will be abolished from the 31st of December 2014. I will, however, introduce an additional levy on pension funds at 0.15%. I am doing this to continue to help fund the Jobs Initiative and to make provision for potential state liabilities which may emerge from pre-existing or future pension fund difficulties. The levy within the existing legal framework will apply to pension fund assets in 2014 and 2015.
So listening to that, Samantha McConnell, expert with IFG Corporate Pension, is this the government's way of funding these new arrangements at no additional cost to the taxpayer?
Yeah, absolutely. Effectively what they've said is that next year the levy is going to be 0.75% and they're going forward it'll be 0.15%. I suppose our issue with the levy or the new levy as it's now being called, is that it's being applied to all pension schemes, not just defined benefit schemes. So effectively he's levying people in defined contribution schemes whom, as we know, already bear the majority of the cost of funding their benefits, to pay for benefits that they themselves will struggle to ever fund. And we would have a significant issue on that. And indeed, we've urged the Minister to actually relook at that levy to effectively just apply to DB schemes.
So in other words, everybody is being levied, even though they are in schemes that may yield less benefit for them than for those they're subsidising, even with the reduced amount for those they're subsidising.
Correct. For example, in a DC scheme, you will never have an insolvency because effectively you're not promising benefits that are underfunded. And therefore, we will never be able to benefit from the legislation that has just been introduced. And therefore, I just think it's blatantly unfair to people in defined contribution schemes to pay for something, as they say, that they will never get a benefit from.
So is it the situation then, Samantha, that somebody who's paying into a pension which they're led to believe will give them something like maybe $8,000 a year on top of the state benefit, the state pension through the social welfare scheme, that person has to pay up the same as anybody else, and it might be for the benefit of somebody who might be getting shored up to the extent of maybe 30 or 40 by way of the defined benefit that they're already in for, the final salary scheme?
I think it's even worse than that, Sean, to be honest with you. In defined contribution land, you have no guarantee of reaching any sort of level of income. That's completely dependent on the size of the fund that you're able to save for and the cost of pensions at the point that you retire. And as we all know at the moment, bond yields are at historic low levels, and therefore buying a pension is an extremely expensive prospect. And that's why we say for most people in defined contribution schemes, they will never enjoy a pension of, say, 50% or even 2/3 of their final salaries. That's just an unrealisable goal for them in this kind of environment.
But is this call going to be made only in situations where you have the double insolvency, or will it apply to some of the other situations that arise where, say, a company is solvent but the pension scheme isn't?
No. Yeah, exactly. It was quite clear from what the Minister put out yesterday that she would see that the levy is to pay for past insolvencies, as in the Waterford Crystal, Estor Technics and the like, and future double insolvencies. Where a scheme is in a single insolvency, i.e. where the scheme is insolvent but the employer continues to go, all she's allowed for there is a redistribution of funds between pensioners and current active members in the scheme. What's interesting, though, is that they also introduced a sort of a hint that they will strengthen the funding requirement for employers so that schemes with below 50% funding for benefits, which is where this legislation will kick in, will meet a higher funding threshold going forward. And we have yet to see the details around that.
Is it fair, though, that there isn't going to be an equivalence of benefit between people already receiving pensions and those who are still paying, and maybe in their mid-30s or 40s, that they simply cannot look forward to the same benefits that people who are already out of work and on the pension are going to get?
I think the big issue for people in defined benefit schemes where you're an existing worker versus somebody on retirement is really for those individuals who are very close to retirement. If under previous legislation, up until now, you really had a situation where you effectively could lose everything if you hadn't retired by the time the scheme was wound up. At least now you have some hope of getting at least 50% of your benefits. And indeed for pensioners, they are protected up to a minimum of €12,000 plus the state pension. Now, if you think that the average industrial wage is €36,000, for most people it means that most pensioners will not be impacted by this change in legislation.
Yes, but somebody who is, as you say, maybe coming up to retirement, they may be 2 or 3 years away from it, all they're guaranteed is 50%, whereas somebody who is already out of employment and on the pension is either going to get 80% or 90% of the pension.
No, if the scheme is a double insolvency, where the scheme and the employer is bust, the pensioner will get
there's equivalence there, okay.
I'm sorry?
I said there's equivalence or parity there, okay, isn't there?
There is. It's only in a single insolvency. That's where pensions are only giving up a little bit. But I think, as I say, while we, this is a step in the right direction. Up until now, if you had a situation where a scheme was bust, if you're an active member, you could walk away with nothing. So getting 50% is a lot better than getting nothing.
And when you say a step in the right direction, what other steps would you like to see taken, Samantha?
I think ultimately, when we were looking from an industry perspective, and I do call them the unholy trinity, it's the one time you find the unions, employers and industry all agreeing on the same issue, and that was in relation to the priority order. One of the things we were looking for was a protection of €6,000 of income. Now, the government has doubled that to 12,000, and therefore we would have a concern as to actually what benefit is this going to be for a lot of schemes. We'd like to see that income level reduced. Ultimately, I think the other thing that I would like to see is some staging of the legislation. So, for example, if you're age 30, you have a long time to go to save for your pension, whereas if you're 55, it's very difficult for you to make up any deficit in your pension scheme, and I think there should be some recognition of that inability to fund up when you're close to retirement age.
Finally, back to you, Aidan McLoughlin. This change that the Minister announced in the pension levy, it's the 0.6% is going to go at the end of next year, but the 0.15 has been introduced. Is that likely to stay into perpetuity, and what about the prospects of it rising?
You'd have to see the potential for it to continue. Firstly, the Minister has indicated, both the Minister for Finance and Social Protection, that this is related to the funding of pension schemes. I think the levy should be ring-fenced away to act as a protection fund for pension schemes. I'd agree with Samantha, it should only be paid by those that are going to ever get a benefit from it. That levying it on people that will never get a benefit from it just makes no sense whatsoever. And therefore you should be looking to use the levy to create the equivalent of a pension protection scheme for defined benefit schemes that only defined benefit schemes contribute to.
A story that's going to run, and one suspects. Aidan McLoughlin, Group Managing Director of the Independent Trustee Company, and Samantha McConnell, pensions expert with IFG Corporate Pension. Thank you for joining us. Back with the debate.